landlords and all the product and commercial product and properties that are on the street. But we're finally coming to a video that's going to talk about the solution, or one major solution that we feel that will be very helpful to the owners.
What is the biggest issue that still remains?
The biggest issue for the people that specifically have purchased properties, have kept fairly significant LTVs or loan to value, that have built a generational wealth or multiple properties, and that have had, in this pandemic, a number of buildings not paying rents, or a significant portion of the building not paying rent, is a major problem when you're trying to get out of or trying to make a forbearance agreement and not going to default. This is the major problem today.
I have heard you use the term generational wealth before. Can you tell us a little bit more about what that means?
Yes, so in generational wealth, people, not everybody, because some people have had, 2 or 3 generations of product, so they may have been smart enough or not that aggressive that they've kept their LTVs at 25 or 50%, or maybe they have very little debt on a lot of buildings, which is great, right? Because when you have a problem, rent stop and rents stop paying, you have the ability, because you don't have all this debt to pay and these high mortgage and real estate taxes that have accumulated on these properties, that could absolutely throw you into default. So the number of people that have built properties, because what do they do? They buy the property, they fix it up, they rent it. As time goes on, it appreciates. In New York, you could buy a building for $10 million 10 years ago, and today it's worth $20 million. What does somebody do? They go back and they mortgage it for $14 million. They take the extra money, they go to the next building, and on and on and on. So imagine having so many buildings with so much debt, and then not having an enormous amount of cash to solve your problems. This would be a big problem for people building generational wealth specifically.
How does the debt service coverage ratio affect the bank loans?
Yeah, this is a great question, and I don't know that most people think about it, but think about this. When you buy a building, or even refinance a building, what the banks do is they make you fill out a global cash flow. So typically, on any purchase or any loan, they look specifically at the building. They say, what is the gross revenue? What are the expenses? And what's the net operating income? Once they know the net operating income, they can take the debt service coverage number that the bank authorizes, usually between 1.20 and 1.35. They take the net operating income and divide it by that number. That would be the maximum they can allow you to have a mortgage for on an annual basis. They can't go over. That's the number. So once they have that, they're fine. Now, you say, what happens now? So I have 10 properties, for example, and now because of the pandemic, I have a pandemic questionnaire, which makes sure that I go up and say, which tenants are not paying rent? And maybe they even go one step further, show me the checks for the last month of every tenant, the front and the back, and who's not paying rent. Now they go back and they do a global cash flow. Take all the buildings, all the NOI and net operating income, and divide it by the debt service coverage ratio. And now that the rents fell or disappeared, it falls below the debt service coverage. Now what do you have? No ability to do a loan. That's the problem. And I think that's probably one of the biggest issues here for people to get a solution to, because what do I do if I don't have the debt service coverage and I don't have enough money to make these changes? What do I do and not want to face default?
So the rescue financing, the solution is focused on asset-based loans. Can you talk a little more about that? Sorry, I want to say
Yeah,
that.
correct. That's a major thing. So that's like, we feel one of the biggest things that somebody can do, and we're taking that approach. So what happens is banks are cash flow people, right? That's the analysis. They usually don't take a building that's worth $5 million and no rent's coming in and say, I'll loan you $3 million on it. They want to know it's cash flowing after expenses, they want to know the net operating income, and that's how they figure out how much they can loan you on the property. So in our case, we're set up with some financial institutions that will look at the building from an asset-based form and not consider the entire global cash flow. But yes, we still have other considerations. Who's the tenant in that building? Are they paying rents? What's today's appraised value? Because if things went down 20 or 30% and the building was $10 million, we want to know that the building's only worth 7, not 10. And then we want to make sure that the tenants are good. If it's a restaurant downstairs, even if they're paying rent, it's still a problem. We want to make sure the tenant's right, location's right. So there's a lot of due diligence to be done here. But once we see that, if there's a low LTV, loan to value, or it's unencumbered, I mean, there's no debt on the building, we could probably lend up to 50, 55%. Yes, the number will be higher, but look at the value that you'll have. You'll be able to go back to a bank, pay down a mortgage so that you won't be facing a default. Another thing that could be done is simply, and we could even go and do a consulting agreement, go into the bank and discuss the mortgage forbearance. And the way we would get to that is we'd say, look, the guy has a certain amount of rent coming in on this property. We don't want to go into a default. We want a forbearance agreement, so what we want to do is we're going to accumulate the mortgage amount, the real estate taxes and expenses, and give you this amount of money as a reserve for 24 months. Therefore, protecting your debt service coverage ratios. And we feel that over 24 months, between the vaccine eventually coming in, the pandemic going away, getting new retailers, whatever it is that we need to do in our building, we'll be able to fix the problem without an enormous amount of money coming in. We'll just give you enough to cover the reserves that you need so that you'll give us a forbearance agreement. That's what we mean by rescue financing.
What would be your concerns, and how do you make sure that these loans have the ability to be repaid?
Well, the concern would be, we don't want to get into a contest that we get dragged out on paybacks in case they default or whatever. So of course we're going to have bad boy clauses, make sure that we have UCC liens, make sure that everything is right, make sure the tenant structure is right, make sure that the LTV is not 70%, maybe 50 or 55%. We try to be cautious of what we do. We'll look on Google and make sure there's no bad boy things happening to these guys, and that they just can't be anybody looking for money. I think that the transparency and the due diligence process would be very important, but I think it can be done in a way that all of us are protected, and the people that are deserving to get help will get the money. Due to the pandemic and the seriousness of what's going on all over New York, the liquidity source is here to help people to find solutions. And feel free to call for advice at no cost, free consultation, and let's just talk and see if we can be helpful. If you're not ready to give us a call at this point, at least do yourself a favor and stay tuned to us on Facebook, Instagram, LinkedIn, TikTok, any of the social media. You can see a lot coming down the road from us, and I think it's going to be helpful.